From a top-down point of view, there are two sets of statistics that will be worth a closer look in the coming week. So, to run through those headlines first, watch out for UK unemployment data on Tuesday the 11th of August. This will cover the 3 months to June and therefore the worst of the lockdown period. The furlough scheme has done its work and kept a lid on job losses so far, as the jobless rate was just 3.9% in May, a fraction below February's 4% mark when the pandemic began to make its presence felt, and still very close to 1973's modern-day low of 3.4%. Then we got the latest Chinese monthly growth numbers for fixed asset investment, industrial production and retail sales on Friday the 14th. They'll cover July, the first month of the third quarter, and could be a good measure of how the world's second biggest economy is faring after a 6.8% drop in GDP in Q1 and a more modest 3.2% recovery in Q2. Remember that in June, fixed asset investment fell 3.1% year-on-year for its fifth straight drop, retail sales fell 1.8%, fifth straight drop, and industrial production offered a little bit of light with a third straight increase, this time of 4.8%. These figures will be a good test of what sort of recovery a major economy can generate as it comes out of lockdown. V or U or tick or L-shapes, or the latest theory offered by some, a square root symbol, which I guess means an initial upturn as pent-up demand returns, and then flatlining after that. There are plenty of corporate updates due in the coming week too, with around half a dozen FTSE 100 firms scheduled to release results, and a good batch of mid and small caps set to do the same. Reports which could prove particularly informative may include the following, either for the insight they provide into the companies themselves or their industry, or the wider economy. On Tuesday the 11th of August, life insurer Prudential, Intercontinental Hotels, real estate investment trust Derwent London, and online gambling specialist Gamesys. Then fund manager M&G, Spirax Sarco, Avast, Balfour Beatty and Premier Foods on the glorious 12th of August. Bookmaker GVC, precision instruments maker Renishaw and transport group National Express on Thursday the 13th. But for me, the stock most likely to cause a big fuss in the week ahead is car insurance giant Admiral. The FTSE 100 firm is due to release its first half results on Wednesday the 12th of August. Best known for its Admiral, Elephant and Diamond brands, as well as its price comparison site Confused.com, Admiral's headquartered in Wales and is a member of the FTSE 100, though it is a global company with operations in Spain, Italy, France, America, Mexico and Turkey, to name a few. Now, the shares have been very solid over the past year, rising by just over 5%, when the FTSE 100 has fallen by a fifth over the same time span. The company hasn't said that much this year, although back in April it did give an update on its dividend policy and trading. On the dividend, to which we'll return in a moment, Admiral suspended payment of its usual annual special dividend in a nod to pressure from the regulator, the Prudential Regulatory Authority. Management stressed the move was in no way a reflection of solvency or liquidity issues. Admiral then announced it would actually give a rebate of £25 per vehicle to all customers, some £110 million in all, because fewer people were driving during lockdowns, so there'd been fewer accidents. The insurer also committed to price cuts worth some £80 million and to helping those customers who were struggling with their monthly premium payments. And as a final point, Admiral noted it had kept all staff on full pay, had not used any of the government support schemes such as the furlough payments, rates relief or VAT holidays. All of this creates a picture of financial strength and confidence in the underlying business, which may help to explain why the shares have been so solid. Analysts will doubtless look for comments on pricing, costs and cash management as they assess the key factors behind the headline pre-tax profit and dividend numbers. In terms of pre-tax profit, Admiral set a new company high in 2019 at £523 million on a stated basis. For the current year, the consensus is looking for a slight dip to £475 million, and your benchmark for the first half is Admiral's £218 million from a year ago. Then on the dividend, Admiral paid an ordinary interim of 41.8p a share last year, followed by a final of 56.3p and a special of 21.2. Now that gave a total of 119.3p a share. However, the company deferred again that customary second special dividend in response to the request from a regulator to preserve capital in the face of the pandemic. Chief Executive David Stevens, who will retire next March and be replaced by the current head of UK and European insurance, Milena Mondini de Focatis, well, he said the company plans to pay that missing special dividend this year. So analysts have penciled in a total payment of 136p a share for 2020, equivalent to a yield at the moment of more than 5.5%. In terms of the finer points, analysts will be looking at the trends in total group customer numbers, which rose 7% last year to 7 million. UK insurance customers, which rose 4% to 5.5 million last year. And also the Solvency Ratio, which ended 2019 at over 190%. Now, this measures how much capital an insurer has relative to the risk that it's taken. A ratio of 100% under Solvency II regulations means an insurer should be able to meet all of its obligations even in the event of an extreme shock. So Admiral appears very well capitalised indeed on this basis. Also, watch out for any comments on Brexit. The company's not flagged any major concerns, but it does have those operations in Spain, Italy and France, so leaving the EU without a deal in place could pose some issues over market access. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.